Welcome back. We are at the IIFL Investor Summit, and with me is Viral Shah, who manages and does research on NBFC. Viral, let's look at the NBFC basket as a whole. How do you place them vis-a-vis your PSU and private banks?
So I think incrementally over the past, I would say couple of quarters, we have been recommending to clients that NBFCs now is the time to be a bit more selective. Reason is, I would say, primarily threefold. One is that the starting point of valuations, I think they are close to their either long-term averages or some of them are trading rich as well. Rightfully so. Of course, it's accompanied by superior earnings growth. But the second reason is that on the relative basis, say vis-a-vis a private banks, the earnings growth premium that NBFCs deliver, the keyword over here is premium, is going to narrow. There's nothing wrong with, say, a larger NBFCs. They will still deliver a 25% kind of an earnings growth CAGR over the next couple of years. But the private banks, and rather I would say most of the banks, including PSUs, the earnings growth for them is going to inflect. So the relative earnings growth premium that NBFCs used to deliver is going to shrink in the context of valuations which is there. And thirdly, finally, I think the key risk for NBFCs from here on is basically with regards to the margins. If we look at the way the bond market yields are behaving, of course the GSEC yields and the spreads are where they are all-time highs, say in a non-crisis period. But when I look under the hood also, and there's a clear-cut segmentation and differentiation, say even within a AAA rated or say a corporate-backed NBFCs or say a non-AAA rated NBFCs. For instance, there has been no reduction in yields for a non-AAA rated NBFC paper in the last 1.5 years, despite 125 basis points of rate cut.
So on one hand, they've been able to reduce the cost of fund from the banks, but if they're borrowing from the market as bonds, the yields are much higher and they're paying up. So it's negating each other basically.
Yes, and secondly, what is happening is we as analysts and investors, we were penciling in margin expansions, cost of fund reduction on back of the repo rate cuts. That is not going to come through, or there is a risk that it may not come through, which can lead to earnings cuts for NBFCs.
So, in this backdrop, which are the segments within the NBFCs which will grow at a steady rate or a faster rate compared to a normal NBFC?
I think incrementally, what we are telling is that within the NBFC construct, one is better placed in NBFCs that are much more diversified, and also I would say who have relative advantages on the liability side, be it in terms of parentage or a credit rating, etc. They seem to be better placed in the overall construct, and it also means that they are going to give you a much better and a stabler earnings growth over a longer period of time. So, yeah.
So, that's interesting that you spoke about parentage and others. If I were to tell you to look ahead, maybe 3 to 5 years down the line, you have digital lenders coming into play. They already have a good footprint, but now you have Airtel also coming into the entire digital lending space. You have Jio for last 3 years, it's been there. You have the big boy of the NBFCs, Bajaj Finance, which is already into there, and all others are trying to bring in digital lending. If I were to ask you on digital lending and how it's going to shape the entire NBFC space and how this new competition is going to work.
So, in my opinion, structurally, many of the newer entrants also do have meaningful right to win. Say, either be it in terms of the digital distribution or say on the liability side, as I mentioned, the parentage piece. What is critical is going to be the execution, which is going to be much more gradual, as we have seen in case of Jio Finance, right? It took them 3 years to reach a 20,000 crore of loan book on the NBFC side. It's going to be a gradual evolution. In the near term, or rather say even a medium term, I don't see any material threat to the larger players. But yes, structurally, if you ask me 3 years, 5 years down the line, competitive intensity will increase. The larger or more diversified players via preferences over there is that they have the ability to keep going down the segments. Whether it is in terms of customers or geographies, you have the levers to offset those competition on the digital side. So I think it is going to be a gradual scale up and nothing to worry about immediately. But yes, this needs to be seen in the construct of valuations as well.
And how do you think valuations will transform from here? Because we've been giving high valuations and high multiples to NBFC because of the kind of natural way of lending there. When digital lending comes in play, is there going to be a rationalization of the kind of valuation for in any manner, or a normalized valuation will come into play because that's a new normal now going to come in?
I think, see, you are right. Part of that has already been happening. We have been witnessing, right? For instance, you look at Bajaj Finance, where it used to trade, say, even pre-COVID, right? And that is again a function of the growth. Back then, it used to grow at a different orbit, 35-40%. Earnings growth used to be materially different, though ROEs could be one scenario. I think eventually it's going to be the proof of the pudding would be in terms of the earnings growth. And as long as, say, if you are able to deliver, say, a 20-25% kind of earnings growth consistently, some of these valuations, even if you bake in, say, prudently some bit of natural compression, you will still end up getting, say, decent 18-20% kind of CAGR returns, which is where I think the larger NBFCs are poised towards.
Are you also looking from a point of view of markets being a little impatient with the kind of earnings which is there? Now, if you're growing at say 20-25%, and suddenly you are now guiding that okay, we'll grow at only 18-20%, it leads to a brutal value correction for NBFCs. Do you think that impatience is now a norm here? Because if you don't meet my way, I have another way basically.
No, see, you are right. It's a function of again the valuations, right? If one is penciling in, say, a steady 20-25% earnings growth, and if suddenly the new reality is more of a 15% earnings growth, there has to be a valuation, I would say, reset which has to happen. In those cases, I think probably it may be warranted. But ones where it could be a more of a temporary blip. I think we have seen enough times when markets either have been patient or that is actually a good opportunity for one to kind of go down and say maybe double down. Case in point is you look at Chola Finance, right? Same time last year, it was basically materially below where we are currently looking at the stock price, right? Just looking at the temporary thing. If you have the bigger picture still intact, I don't think markets would be as brutal eventually.